In this video, I'm going to go through how to think about asset allocation for those that are planning to retire early. And I'm going to do so by sharing a case study of a $3 million investment portfolio and the steps we went through constructing exactly that. Because understanding how to optimize your allocation is critical, especially if you want to consistently generate income for the next 40 to 50 years of retirement. And you should also know that the steps that we covered today in this video apply to you whether you have $500,000, $1 million, or even $10 million. It all comes down to the principles that you're going to learn in today's video. And if we haven't met yet, my name is Matt. I'm a certified financial planner and advisor over at 1 Degree Advisors. And on this channel, I make videos to help you retire early with confidence. But first, I want to talk about the wrong way to choose an allocation for an early retirement. What most people get wrong about asset allocation is they'll just take your age, they'll take your tolerance for risk, and then they'll slap a portfolio on you like 60-40 or 50-50. But what I'm going to show in today's video is that that's clearly an incomplete analysis. Because if someone met with the folks I'm going to talk about in today's video and just slapped on a rule of thumb allocation, it really wouldn't make a whole lot of sense. Because when you build a portfolio, we want it to actually follow what you want your life to look like. You'll see that for them that they have other sources of income in the mix that make a big difference, which you're gonna see in the video. So let's meet Mike and Jessica. Both wanted to retire in their early 60s, and these are not real names, of course, but their story will sort of paint the picture for you as you start to think about your own early retirement portfolio. So let's start out with their balance sheet, because these different accounts, the investment accounts that you pull from to create retirement income, can really change the trajectory of the way you invest your money. So I'm using round and general numbers here, of course, for privacy. But if we break things down by account type, they have cash of around $50,000. They have a joint brokerage account, non-retirement account of around $900,000. Mike has around $1.5 million in a 401k. And then finally, Sarah has a 403b with about $600,000. And then under the assets over here is the home residence that still has a mortgage on it. The value is about $950,000. So if we're just looking at assets they expect to spend from retirement, that puts them right about at $3 million in total investment assets and cash. Next, below here, as far as liabilities go, they still do have a mortgage, and it's around $120,000, and it's still a pretty low fixed rate, which we're going to keep throughout their retirement. So with about $3 million saved, it costs a few different accounts. Let's see how much they can expect to be able to spend from this portfolio over time if they were to retire next year. Because once you understand how much you want to spend, you can then start to put all these different puzzle pieces together. So what you're now looking at on my screen is the retirement income visually and what it might look like over the span of their retirement. And what the research has shown for how retirees actually spend is what is more commonly seen as a retirement hatchet, this little hatchet thing you're looking at on my screen. And what happens is that the initial retirement distribution rates from a portfolio are generally higher in the early years. They call this the go-go years, like you're seeing in this light pink portion of their screen here from 2026 to 2032, and then will significantly drop when they claim Social Security, like you'd see in 2032 here. And you can see that this pink downward slope of portfolio spending is falling further over time because of the tendency for retirees spending to actually decline in real dollars as they move through retirement, as they age into the slow go and the no go years. Now this chart is also considering all other sources of income. You can see like their pension as well as rental income, which a simple analysis like the 4% rule really would fail to account for. The point is that you want to have a plan that considers all your other sources of income, because it's going to impact how much you need to withdraw from your portfolio to cover what you need to spend. And to tie it all together, how we end up allocating your portfolio so you can spend what you want to spend in retirement. So we're going to start to get a little bit more in the details here because this is really important for people to understand, but the math sort of starts to change when you start going from the growing and saving to now you're starting to spend them down. Now for Mike and Jessica, they asked, as many people do when they start to get into retirement, where should I pull from first when I retire? And I like to share this little picture with folks and that are thinking this through, and most people are familiar with this, but you have the taxable bucket, the tax deferred bucket, and then the tax free bucket. Now each bucket is going to have different tax characteristics, and they're not going to be all equal as far as which account you should take out money for, especially for retirement income. and also how you should position different investments inside each different account to maximize the tax efficiency. Now for Mike and Jessica, if we look at their account buckets, they have around 70% in the tax deferred bucket, 30% in the taxable bucket, and lastly 0% in the tax-free bucket at this point. Now the approach that we're going to take a first look at is the one that you've probably heard of, which is a rule of thumb starting with taxable, moving to the tax deferred, and then finally what's left in the tax-free bucket. And if we look at their income in the first month based on their assets and other income sources, we're estimating that they can generate a monthly income of about $17,500 from all their income sources combined in those initial years of retirement. And of that, about $13,000 is available to be generated from the portfolio. Now, that's a starting withdrawal rate of 5.2%, which might alarm people if they've only heard about the 4% rule. But in this video, I'm not going to break down why they have the ability to spend more than the 4% rule, which I often do in other videos. But at the end of this video, I'll point you to a resource that explains exactly how. And again, this is how much they have available to spend if they took that taxable, tax deferred, and then tax-free approach as far as retirement income. Now, this is usually an optimal way to spend down assets in retirement, but this rule of thumb can cause a massive tax problem for people. If your financial situation is anywhere similar to Mike and Jessica, it can also cause problems for you as well. So let's take a look, a 10,000 look view at projected taxes over their lifetimes. Now, each bar here represents 1 year of their life, and the size of the bar represents the tax bill. So in the first 8 years or so of retirement, they have a really low tax bill, which could feel really good initially, but then looks would start to sneak up later in those later retirement years. When they have to fully rely on those tax deferred accounts to create income, you can see a big spike here in about 2040 because they have to start taking those forced distributions from these pre-tax accounts. Now, this is why this couple is a great candidate for Roth conversions, which we're not going to go down the rabbit hole in this video, but just know that this can lead to saving thousands, if not hundreds of thousands of dollars in taxes over their lifetime, which we shared with them the full analysis. But what you should know is that coupling your asset allocation with your tax plan is critical. And we often have folks that reach out and they say, hey, my advisor isn't looking at any sort of tax planning. They'll only do the investments, which sometimes is really surprising to me, especially with assets like this, because nearly every investment decision you make will have a corresponding tax implication. And even many advisors get client asset allocation wrong by missing this one critical step. So there is a famous paper out there where researchers found that an asset allocation and overall portfolio structure was responsible for 93.6% of the variations in portfolio quarterly returns. Not stock picking, not timing, not taxes, but asset allocation. Now, a lot of people, they come to me and they say, hey, Matt, I want to retire early at 55, I want to retire at 60. And I look at their portfolio and sometimes it's 100% stocks. And that's not a problem per se at this point because they're not retired yet. But oftentimes I'll see a significant portion might be appreciated employer stock. And the fact of the matter is that employer stock had probably done pretty well for them. Most of the time when people come to me, that's the case. And when we really start to unravel these things, they start to realize that the last 20 to 30 years of things that made them successful are not the same things that will make the next 30 years successful. Because the math sort of changes where we're not just looking at investment returns, where it's about tax savings returns and tax efficient withdrawal strategies. So let's go back to the chart that I talked about earlier, which was showing that based on their situation, they have the capacity to spend up to $13,000 per month from the portfolio. But this is just a tool we use to show people what's possible based on their situation. In reality, they let us know they really only need to spend about $10,000 per month in total income to cover everything. They don't feel like they need the extra monthly income, but maybe they'll spend a little bit extra on travel or once in a while different trips and vacations. But the thing here is that their pension covers around $2,800 per month. The rental, it nets around $1,500. So that leaves them around $5,700 that needs to be made up from the portfolio, at least until Social Security kicks in. So they can spend up to $13,000, but they only want to average that lower amount and maybe take out more on a periodic basis, pretty much as needed. So when I'm building out an early retirement portfolio, what this tells me is that they need about $70,000 per year in portfolio income, of course, adjusting for inflation over time, at least at this rate. And also what this tells me is that we need to have enough income on the side in a safer bucket. So when, not if, markets have a correction during that 40+ year retirement period, you don't have to worry about it. So in reality, what I like to do is have a minimum amount of funds set aside that could be anywhere from 4 to 8 years of income, depending on what we agree upon. And what we know is that market corrections generally happen about every 4 to 5 years, and they last on average about 15 months or so. But again, that is the average. What happens if a tech bubble or a 2008 type recession occurs? That's why we want to set aside what we call our war chest of cash and bonds to be there for you, so you don't have to sell from long-term assets like stocks. So for example, we propose, what if we did 8 years of secure income, which could be in treasuries, inflation protected bonds, municipal bonds, etc. Now, not all bonds are equal. We prefer higher quality and shorter term bonds at times, but that's about $560,000 that is in that safer asset bucket, which is only about 18% of their retirement assets. So the other 2.4 million of their portfolio can be a lot more flexible and target perhaps long-term growth. The way my firm has been helping people successfully retire over the past several decades is having multiple return streams in your investment portfolio. And if you want to read a little bit more about that, I've actually included the link to my firm's investment policy, which we share publicly in the show notes for your own reading pleasure there. Now, we can run this analysis for someone. They might not just have the stomach to lean that growth focused in retirement. I have a client that has over $2 million, and I know that they sleep a lot better at night by taking on a less risk. And if your plan is a good spot where you don't necessarily need to take on all that additional risk, I want you to have an investment plan that can help you sleep better at night too. But it's important because Mike and Jessica, we don't just want to put 80-20 in all their accounts, because that's just not a tax efficient way to build a portfolio. For them, they have 70% of their assets into tax deferred accounts and 30% in that the taxable account. And what we know is that the more tax efficient way of withdrawing money for them was starting out with that taxable account first. So if we look at the first year withdrawals, around $76,000, of course adjusted for inflation, is coming from their taxable account, and $0 is coming from those other pre-tax accounts like the 401k and 403b. And what that is telling me is that we need to think about layering more conservative investments in that taxable account, because we're taking income from that account. And of course, for this type of account, most of the time folks come to me and they have high capital gains. So we want to position this for retirement, but we don't just want to necessarily rip off the Band-Aid tax-wise. We want to be strategically allocating it bit by bit. Whereas the retirement accounts, we can just position them for long-term growth right away without any sort of tax consequence. But of course, that won't be the case forever. We won't be long-term growth in those accounts forever, because eventually in 2040 for them, required minimum distributions kick in, or maybe perhaps, of course, life changes, their plan might change, tax laws might change. And this is why you need to continue to monitor your portfolio allocation and not just have a set it and forget it allocation for the entirety of your retirement. So I hope you found this useful. This is sort of a glimpse and behind the scenes of how we help folks retire early with confidence. I made another case study on early retirement, and in that case study, I go more into detail on some of our withdrawal strategies for early retirement. You can watch that by clicking right here. Again, this is Matt. I'm a certified financial planner and advisor over at One Degree Advisors. If you'd like to talk to me or someone on my team about your plan to retire early, you can click the link in the description below, and thanks for watching.